Distinguished guests and fellow colleagues, welcome to today's CLC IRES joint lecture. My name is Pei En, and I am from the Center for Livable Cities. In today's session, we are honored to have with us Professor Joseph Joko, who is the professor and director of the Zell Lurie Real Estate Center at the Wharton School, University of Pennsylvania. For his lecture today, Professor Joko will be sharing his insights on the role that government and private sector developers can play in effecting macroeconomic stability measures in the real estate industry. He will also be sharing on how Singapore can learn from its past successes and challenges faced in this area. The format of today's session will go as such. We will first begin with a presentation by Professor Joko, followed by a moderated discussion and a Q&A session with the audience. The moderator for this afternoon is Dr. John Sequeira, the Principal Economist and Head of the Modeling Division at the Monetary Authority of Singapore. Shall we now begin by welcoming Professor Joko on stage. Professor, please.
Thank you very, very much. It's a great pleasure to be back in Singapore. I appreciate the invitation from the Center for Livable Studies and also IRES. I have the honor of serving on the Institute for Real Estate Cities Advisory Board with Dr. Seek. He's been a longtime friend of mine. We work together, we do a lot of research together to this very, very day. What I'm going to talk about for the next 30 minutes, and I really don't intend to go any further than that. I think it will be more fun for all if we have more of a discussion rather than just a straight lecture today. I'm going to help us think through what are some lessons that at least I've learned from the global financial crisis in the United States and its impact on the American housing market, a market I study a lot. And then I'm going to try to take some of those lessons and see what we might learn from what's going on in China today. China is also a housing market in particular that I study a lot. What I'm unfortunately not going to be able to do is walk through the history of the Singapore market. It's just not a research focus of mine, but I also, in self-defense, I think it's very useful for all of us to look outside of our own countries for examples of what's gone on. So hopefully it'll be informative today. And the questions on, what the Land Authority in Singapore ought to do, we have many experts in the room, and I'm sure they can answer the questions. That's the method behind the madness, as it were, today. To sort of, this is the entire discussion outline. So what do I think is going on? What do I think about this topic in general? One is, I think there is a role for government. That may surprise some of you who know my history. I'm a University of Chicago trained economist, and I'm a 59-year-old University of Chicago trained economist. So I learned the pure version, which was that, the private markets always work, and that's the efficient outcome. There's very, very limited role for government regulation and the like. There's nothing like the global financial crisis and the Great Recession to cure you of that belief. So it's quite clear that as a general matter, whether you're here, whether you're in my home country in the United States, whether you're in China, that private markets don't always work out perfectly. People have, odd incentives, misaligned incentives. Sometimes just bad shocks happen that threaten to topple the whole system, and there's a need for government intervention. But the second line up there says, just because the private markets don't work efficiently all the time does not mean that government regulation of any type is the answer. Because governments have limitations themselves. I think there are two very recent examples that illustrate that. Number one is from my country in the United States, After the global financial crisis, we passed something called the Dodd-Frank Bill. The Dodd-Frank Bill is many, many hundreds of pages, if not thousands of pages of regulation of the banking and financial sector in the United States. The length of that bill tells you that there's just minutia and detail, and they've tried to anticipate everything that could go wrong, but obviously that's beyond human powers. So we're basically in the process of over-regulating our banking sector. The second example of the limitations of government in regulation, I think, is China's recent experience with trying to manage its stock market, the boom and the bust there. In my humble opinion, it did not do a very effective job and was counterproductive towards what I presume are its long-run goals of increasing liquidity in the stock market in China through, I think, a mishandling of the stock market decline in that country recently. So you have to be careful about what regulation you're going to propose and what you think governments are effective at doing. At the end of the day, I'm going to argue for what I like to think of as principled flexibility by governments in terms of regulation. And the principle is, the goal should be to make the market work better. That's very different from making prices higher, right? All my friends in industry would just like the government to enact policies that increase prices. That should not be the goal. Sometimes prices are too high, so they need to fall, etc. But principled flexibility by the government would be engaging in actions that help the markets function more efficiently. And prudent principled flexibility does, I think, include a role for the governments to make sure there's enough equity in the system so that if there is a negative shock, it won't collapse and the like. And that's going to be a call for what the monetary authorities around the world call macroprudential regulation. I think there's a principled role for that, and I'm going to try to illustrate it in the case of my home country. That's where I'm going to come down. I think there is a role, but I think it's a fairly limited role, and I worry that governments see inefficiencies in private markets and tend to overregulate. I think that's the thing I worry about. Now, as governments and practitioners in the industry think about cycles in real estate, I think there are 4 points I'm going to emphasize as I go through examples from the United States and China. Number one is, it seems obvious, that first point is understand what really happened in the markets. In the United States, I'm going to show you a bunch of data. I would guess if I asked you what happened in the United States, for those of you who know my country, you would go, in terms of the property markets, it was a subprime crisis. It wasn't. It's just untrue. I'll show you a bunch of data. Subprime was a really small part of the issue. So understand what really happened in the market before you try to regulate. And that's going to make regulation much more difficult in the United States, because if the problem in the US was as simple as the subprime sector got out of control, the regulatory response is pretty clear. Just regulate that one sector, fix what went wrong there, and you're pretty much done with it. But my argument's going to be, once you look at the data, I think I will be able to convince you it was a much more systemic problem than subprime. Number two is, I think it's really important, both in the US and particularly the Chinese context, and I suspect in the Singapore context too, is that before you regulate the property markets or lending in the property markets and the like, it's important to understand the broader economic and regulatory environment in which the property markets operate. I'm going to go through, again, examples from the US housing cycle and the recent Chinese boom. In the US case, the boom in housing was part of a general leverage increase in the United States in the household sector that financed increased consumption without real economic growth and without much job growth in the US. In other words, it was part of a fairly dangerous and ill-advised policy in the US at the turn of the century that enabled increased consumption just with more debt, but without the underpinnings of real growth. Real estate was just part of that issue. And when you think about regulation, you need to keep in mind the broader systemic context in which property operates. He said, keep both in mind. And then last but not least, the fourth point is be prepared to change your mind as new information becomes available. As the data became clear that the U.S. downturn was much more than a subprime event, that should change your view on appropriate regulation in the United States. My basic recommendation for the private builders and investors in the room is really quite simple. I don't think anything's changed. I don't think we've learned all that much about what will keep the private market solvent in a downturn. That's called equity. You have to have a well-capitalized structure, financial structure underpinning your firm, because property market cycles are both long-lived, they're multi-year, almost always, and they have high amplitudes. They go way up and they go way down. You can only survive the downturn with equity. And that's not a new conclusion. In the United States, 75% of private home builders went bust, went broke in the last U.S. housing downturn because they weren't well capitalized. It was a very big downturn, but they didn't have enough equity to survive it, and there's pretty much nothing you would want the government to do about that. The reason is that in the United States, and I believe the same is true in China, home builders, property developers in general, are not systemically risky for the entire system. If they go broke, that's bad for the investors, for the owners and managers of those companies, but they will not crash the broader economy. Okay, so I don't have much of a role, I don't see much of a role for government there, but for the private investors, they simply have to have the staying power to survive a downturn, and that's a function of equity. Equity is the ultimate shock absorber to downturns. I'm going to use examples from the U.S. and China's residential boom. In the question and answer section, in another part of my research life, I think about the commercial, non-housing property markets a lot. In the interest of time, I'm not going to say a word in my talk. I'm happy to answer questions about it. I think there are important differences between housing and non-housing cycles, and we can talk about that later, but I'm going to focus on housing in my talk. Okay, case study number one, the United States housing boom. The key features to keep in mind for you is that what happened in my country was, it was an extraordinarily strong and long boom. The boom lasted a decade, from 1995 to 2005. That's a very long time period. I'm going to show you some plots which basically say that prices went up 4 to 5 times more than they did in previous booms. Okay, that should have been our first warning sign, by the way, that something was amiss. The cycle was fundamentally different in its strength. But not only did prices go up, quantities went up. By that I mean we expanded the pool of home ownership in the United States by a lot, by 5 percentage points. And what does that mean, on the ground in the U.S.? Over the time period I'm talking about, there were about 120 million households in the U.S. We're a very large country. Every percentage point is 1.2 million households. A 5 percentage point increase in the home ownership rate is 6 million additional owners. It's a big increase in the pool, and a significant number of them were risky. They were financially fragile households. So we did something very unwise, and that's going to lead me to macro-prudential regulation. I think one of the things our regulators have learned is they have to take a look at what's going on in terms of the risk profile when you see big changes in demanders for home ownership like we saw. Okay? Point number 2, the bust was incredibly widespread too. It was not just subprime. The vast majority of defaults and losses of homes were by people who took out prime loans, not subprime loans. Right? Number 3, this is the context issue I talked about. This big leverage finance boom in housing was part of a more general increase in household leverage in the United States that was really critical to the functioning of the U.S. economy, and I think it should influence how we think about leverage a lot. So now the fun part, the pictures. There are two really, really great housing price indexes in the United States. What's now called the S&P Case-Shiller Repeat Sales Index and the Federal Housing Finance Administration Price Index. The Case-Shiller is the green index, the red line is the FHFA index. And these show the last 3 cycles. And let me just sort of walk over here and tell you. So, cycling in housing markets is nothing new. They cycle in the United States. They're going to cycle in China too. We just had a decade-long boom, but China's not immune to cycles. They cycle in Singapore. You're cycling down now. There's a question about will you cycle down further, but cycles are normal. We've had 3 in the last 35 years in the United States. The first 2 from the late 70s to the early 1980s. For those of you who've forgotten your math, these are log points. So the move between 4.4 and 4.6 is 20 percentage points. So basically, and these are in real constant US dollars, all the US plots. Property prices went up about 20% in real terms. They then went down 20% in real terms. We had another boom, another bust, and you really want me on this, okay? I did the thing. You saw a similar cycle, and then you saw the cycle for all time. Okay? That one's clearly a different cycle. Beginning in 1995 until 2005, we had a 50% real increase in aggregate home prices nationwide. In the United States, there was about 50 percentage points of inflation. So in nominal terms, aggregate house prices in the United States doubled in a decade-long boom. And then we had the Great Recession, and it all unraveled, almost totally unraveled. So point 1 is, if you have history, as Singapore does, you guys have historical data, the Chinese don't, right? They privatized in the late 1990s, and they've had pretty much one big boom. So they don't have past cycles to compare to. The first warning sign for us should have been, wow, that cycle's really historically big. Is there any reason to believe it's justified? Now, how did we justify it? We justified it by the tech boom. The rise of the World Wide Web, new technology was making the country more valuable. Again, if you're a regulator, you need to react to that with skepticism that it's new, it's different this time, and the like. The other thing to note for the United States, this is very different from Singapore, right? We're a big country, lots of open plains, land, and the like. If you, let me see, can I do the plot? Yeah. If you draw a line from the start point of that to that, you will get about 0.75% real appreciation compounded over time. On average, across cycles, housing does not appreciate at more than 1% a year real in the United States. Owning your home is not the route to riches in America, right? That's just what the historic data tell you. A lot of my fellow citizens don't believe that, but the data are the data. That's another point, I think, for both home builders, home buyers, and regulators in the United States to keep in mind. Now, I believe that's going to largely be the case in China, another big country with a lot of land, although there are going to be exceptions to that. It's almost certainly not the case in Singapore, and it's not the case in all markets in the United States. Real quickly, next 4 slides are going to be 20 markets that are major markets in my country from 4 different regions. And the first one is the Sun Belt. For those of you who don't know the geography of the United States, these are 7 markets from the south and southwestern tier of the United States. If you draw a regression line from the beginning to the end of all those series, it's flat, okay? What that says is, in the Sun Belt markets in the United States, real constant quality house price growth is 0 over the past 3 cycles. Why is that true? Because in all of those markets, they just build more housing whenever they need it. There's lots of available land, and if you remember your old econ class, what that means is the supply curve's flat in those markets. You just build all the houses you want at the old price. Home builders just enter the market at will and build whenever they can make a profit, and therefore prices are bid down to the cost of housing, of producing the extra unit. It's intro price theory 101. It works in those markets by and large, and over long periods of time, they haven't cycled. But something interesting happened in 3 of those markets. That's these guys, 4 of those markets. That's Phoenix, Las Vegas, Tampa, and Miami, the so-called sand states, Florida, Nevada, and Arizona. They had wild booms in the last cycle, and then they completely busted and reverted back. So that's one set of markets in the United States. Second and different set, and this is what Beijing and Singapore look more like. These are the big 3 East Coast markets, Boston, Washington, and New York. And these markets cycle, you can see the cycles. So they go up and they go down, but they go up and they go down about a really strong positive trend. That's a 2.5% to 3% real compound growth rate across those 35 years. And if you do 1.025 to the 35th, that's 2.37. In other words, real prices in our coastal markets more than double every 30 years. They keep going up and up and up, and they're supply constrained. They're very different from the interior markets in the United States because they're on the coast and they're tightly regulated. Local, unlike, so if you guys are a city-state, there's a similarity, which is the government controls release of land. Local governments control the ability of developers to enter and build housing units in the United States, and in our coastal markets, they limit it. Okay? And those limitations in the face of strong demand lead to rising trend prices. They still cycle, but they cycle about a rising trend. That also tells you if you're a regulator, you're not as worried about collapses in those markets. Why? Because in the long run, you believe there's a rising trend that'll bail out price falls. The next 2 markets are the Midwest, which has a flat trend in the west, San Francisco, Los Angeles, Seattle, which looks pretty much like the East Coast. But keep it in mind, this is going to be important for China. China, like America, is a big country. Not all the markets are the same. They behave differently in the last cycle in the United States. They are behaving differently in China as we speak, and you need to consider it on a market-by-market basis. That's what happened with prices. It was an incredible boom in aggregate and in some markets, but not all markets in the United States. What about quantities? This is the home ownership series I told you about, where from 1995 to 2005, the home ownership rate goes up 5 percentage points from 64% to 69. And I started this series in 1965. We have data back to the 50s. We've never seen anything like that rise in home ownership, and it's a big number. Again, I went through that rise in home ownership is 6 million additional owners in the United States. That's absent population growth. Over that decade, we got about 10 million additional owners. 6 through the rising home ownership and 4 through just normal population growth, and the like. So what happened? We had a big home ownership rate boom. It skewed up demand, and it takes builders a while to build, even in the United States. So temporarily, you saw a lot of upward pressure on prices. People can start to believe that those price increases will be permanent if they last long enough. You can just have flawed expectations and the like. And part of the reason I think they developed in the United States was that long 10-year increase in the home ownership rate. It was really quite extraordinary. The other thing that was happening was an expansion of credit. This graph's a little hard to see, but I just want to make the point that the expansion of mortgage credit in the United States was not restricted to subprime borrowers. So again, this is detailed. There's no reason to memorize this, but in the U.S., we rate borrowers by the credit score. And a traditional way to call someone a subprime or risky credit is if they have a credit score of 620 or below. Okay? So I show you the median credit score of of purchases of homes here. That's the median, and note they have a 700 plus credit score. The typical borrower purchasing a home during the boom was a prime credit. They were not a subprime credit. That line down there is the 10th percentile FICO score among people who took out mortgages to buy homes, which is virtually everyone in the United States who buys a home. They do it on credit with a mortgage. Those guys are below 620 for the most part during the boom. But so one, the credit boom was widespread. The typical borrower was not subprime. The typical borrower was a good credit prime borrower. And you can also see it in the ownership shares. This dotted line here is the share of all homeowners in a sample. This is based on research a colleague of mine, Gordon Fernando Ferrer, and I are doing on 96 major markets in the United States. The top 96 markets include all markets you could name, even if you know a lot about my home country. The 97th market is really small and is in Iowa. It's Ames, Iowa. 60% of all homeowners are prime borrowers. This is the subprime series down here. The subprime share certainly went up from about 10 to 20%, but it did not take the prime share. So again, the boom in home ownership was very widespread, was not restricted to subprime. Next point, I'm almost done with the US, is leverage. This is the average initial loan-to-value ratio by different types of borrowers, and I want you to focus on that line, the triangles, which are subprime borrowers, and the circles, which are prime borrowers. Now note, for prime borrowers, initial loan-to-value ratios of purchase actually declined slightly during the booming. So there's no evidence that home buyers were leveraging up at purchase. Okay? The same is true largely for subprime. You do see a bit of an increase from 82 to 85%, but that's not enormous. And by the way, 80% loan-to-value ratios are normal in the United States. That's a standard that's allowed in the United States. And don't worry about it. The other series are really small fractions of the home ownership series. So first point is, initial leverage was not high as the boom built. So what happened? What happened was that price series you saw, the big boom and then the bust, it led to people believing that they had a lot of equity. This is actually not initial loan to value, but ongoing current loan to value that we estimate in this other research I talked about. And note, loan to values are going down. Again, look at the circles, that's the prime borrowers, and the triangles, that's the subprime borrowers. And loan to value, they believe they're building positive equity in their homes. Why? Because house prices are going up and they're slowly amortizing their 30-year fixed rate mortgages. But then we had the Great Recession and a massive collapse in housing values. That 50% real increase, that 100% nominal increase unraveled, and as it unraveled, again, look at the prime borrower. By 2008, the average prime borrower had negative equity in his home. The average prime borrower had negative equity. It is true, remember the subprimes of the triangles? They're 25% negative equity on their homes. That's what that graph shows. So the subprime borrowers are in deep financial distress, and they're going to default at enormously high rates. But the financial distress was great throughout the home ownership sector, not just the subprime. Okay? This is the total amount of foreclosures and home losses through short sales in this sample from 96 metropolitan areas. And again, this is the prime thing. It was always, even at the beginning of the cycle, more homes were lost and defaulted upon by prime borrowers than subprime, even though subprime default rates were higher. How could that happen? The prime share of the home ownership set was so much higher. So again, very, very broad, very broad collapse. That's just the unconditional distress probability. So that's what happened in housing in the United States. Remember I said I don't think it's enough just to look at housing. You have to look at what's going on in the broader economy. What role is housing playing in the national economic context? And in the United States, the broader context was not a particularly great one for us. Number one, at the turn of the century, economic growth had slowed, but it remained positive. Between the year 2000 and the beginning of the financial crisis in 07, 08, the economy grew 20 to 22% in GDP. And real GDP grew 20 to 22%. However, employment growth was very close to zero. It was only 3% higher when the financial crisis hit than it was in 2000 at the turn of the century. So the labor market had slowed dramatically well before the financial crisis. And the rise in homeownership and debt was part of a broader increase in household sector leverage, and that's what allowed us to grow the economy. We basically, without adding many new jobs, we increased GDP. How did we do it? We increased borrowing to consume. And that's a dangerous game to be playing, and that's the broader environment in which the housing boom occurred. And when the housing bust occurred, it occurred amidst a very weak, over-levered household sector. And it led to one of they call it the Great Recession for a reason. It was the worst downturn in the United States since the 1930s, and the big one back then. Owner-occupied housing was the key vehicle for most households to lever up. Okay? This is just the data. This is real GDP. Since the turn of the century, if you go from that point to that point, that's a 20 to 22% increase in real GDP. That's actually slower than we had been doing, but we were growing at the time. And you can see this is the Great Recession, and we've since recovered out of it in GDP terms. The labor market was a very different story. Okay, now here I went back in time to show you how much the labor market has deteriorated in the United States and how much it had weakened prior to the global financial crisis. Here, 1980, 2000, 90 million jobs, 130 million jobs. In the 1980s and the 1990s, the United States added 40 million net new jobs. That's about 4/5 the size of the German labor force. We basically grew Germany in the United States in 1980 and 1990. It's a remarkable achievement for a rich country. Okay? But go to 2008. You can tell when we're going to fall off the cliff. Note the trend growth rate in the labor force in employment prior. It had slowed dramatically before the financial crisis. So something went wrong in the American labor market at the turn of the century, and well before the crisis hit. We have finally grown past the pre-crisis peak, but it took us almost 7 years to do so. The last time we had a lag that long was the 1930s. So this was a very, very serious downturn, and the labor market remains sclerotic. It remains weak in the U.S., although it's getting better. I'm more optimistic these days for reasons I'll talk about later. That's what's going on in the labor market. This is consumption's share of output in the United States. Again, it goes back to the 1947. I just wanted to show that, we've been becoming richer and people consume more as they become richer. But note the dramatic rise. You see here in the mid-1990s, the dramatic rise from about 64% to 68%, 69%. That coincides with the housing boom. Now, how did we do that? I just showed you that basically real output went up 20 to 22%. Total employment barely increased, but consumption went up. And that's what drove the output increase. Consumption is a very high share of national output in the United States. How did we do that? We borrowed. We quit saving. Okay? This is the personal savings rate in the United States. And again, I went back to the end of the Second World War to show you that after the Second World War, the United States saved the personal savings rate was between 6 and 12%, In 1980, we started a long-term secular decline. We got down to, just about 2% at the height of the housing boom. So what were we doing? The personal savings rate, by the way, measures the fraction of your after-tax income you don't spend. So that's the share of the income you don't pay to the government that you didn't spend. And by 2005, 2006, we were spending 98 to 99 cents of every dollar. We quit saving the old-fashioned way by just not spending everything we earned. What did we believe? What were we doing? We were saving through asset value increases. We thought we didn't have to save the old-fashioned way. By not spending all that we earned, we saved through housing. Okay? Now, this is a complex graph. The only one I want you to keep an eye on is this red line. That is the Federal Reserve Board's estimate of housing value owned by the household sector. Okay? And what happened was that went up by $17 trillion from the beginning of the boom in 1995 to the peak in 2005. Went up by $17 trillion. And that's what we thought we were saving. And that led us to believe as households that we could spend all that we earned, and our household balance sheets would still be strong because our house values were going up. And that worked until it didn't. That worked until 2006, 2007, when the housing market unraveled. We lost $7 to $8 trillion in house value, and that's the financial crisis in the United States. It turns out our banks were not well capitalized. It almost crashed the entire system. Massive intervention by the Federal Reserve was needed. But that weakness in the household sector, it was a weak, highly levered household sector that had quit saving and that had believed it was saving through higher house values, which turned out to be illusory. That's what happened. Here's the bad news and the good news for the U.S. This is, again, a Federal Reserve Board estimate. It's just a ratio of all household liabilities, and home mortgages are the dominant liability in that series, to disposable personal income. At the height of the housing boom, that number got to 135%. Now, the Fed has a version of this back to the 1920s when the Federal Reserve System was initiated in the United States. The last time this ratio got above 130% was 1929. The 1920s were a leveraged finance consumption boom in the United States also. A lot, not exclusively through housing, but a lot through housing. Now the good news for the United States, and my sense of optimism about our ability to grow going forward, is the household sector's delevered quite a bit. We're still not where we need to be, but a lot of deleveraging has gone on, and household balance sheets are much stronger now, and you can see it also in the previous graph. Note, we have recovered most of the loss of house value. Okay, it's virtually all back now, and household balance sheets are okay. Consumption is starting to rise. I think growth is substantially more sustainable. That is the U.S. system. Now, what do I make of that? That's the broader context. So what do I conclude before I go to China? Let me make sure I cover my points. I do have some notes on this. Essentially, what I take from my study of the U.S. is that the first thing we should have seen was the cycle itself was abnormally large and long. And I think regulatory authorities, whether you're the Federal Reserve or a housing authority or whomever in the government, should closely scrutinize any cycle that is of a different size and amplitude than existed in the past. Now, this is going to be impossible for China to do because they don't have past cycles to study. But we do in the U.S. and you do in Singapore, and you should take account of that. Number two, there was actually, one of the things that fooled us is there was no rise in initial loan-to-value ratios at purchase. That's fiction, right? There's this lore that somehow people were leveraging up at home purchase time. They weren't. The data are quite clear. They weren't. It looked safer than it was. What was happening was prices were rising very rapidly, people believed the price rises were permanent, and they used the same leverage ratio they were before. And our downturn started when the price increase unraveled. For me, that says there is a role for prudent regulation, particularly by the monetary authority in the United States, and I think here and in other countries. What they should have done was have been looking at the price rises and asking themselves, what's odd about this cycle, and is it justified? One reasonable policy, I think, would have been to tell the banks, if you want to keep making loans on those super high house price values, you have to have more equity. In other words, I would not have banned the bank loans, but I would have said, you have to really believe that you're going to get paid back, and I'm going to make you be more capitalized. That, I think, is a prudent regulation by the authorities. I would hope China would think the same way in very high house price growth markets, that they would tell the people investing in those sectors, look, you're going to have to put up more capital because those prices look kind of high to us. In general, for the builders, like he said, I don't think there's anything new here. This was a massive collapse in the U.S., and as I told you, 3/4 of all non-publicly traded home builders in the United States disappeared in the downturn. Now, they didn't have enough equity, and granted, it was an enormous price collapse. Prices in Las Vegas dropped 60 to 70%. If you were a home builder in that market, there's almost no way you could be well capitalized to survive a decline. That's why almost all the builders in Vegas disappeared. But I don't think there's a particularly important role for regulation in the United States or in China, because home builders in the United States are not systemically risky to the financial system. In other words, our problem with the financial system was not that a bunch of home builders went broke. It was that the banks were too highly levered and couldn't tolerate slight declines in values. Right? So I don't see a particular role for regulation there. And my advice for all the people operating in the private sector is, you just have to be honest with yourself of how big you think the downturn could be. It's very, very hard to predict. I didn't predict the downturn of this magnitude, but you need enough equity to survive whatever downturn is going to happen. So that's my U.S. view. What about China, real quickly? China's different in many, many ways. And it's dangerous to think, and it's not just dangerous, it's wrong to think that if there is a bust in China, and I think it will bust in certain markets, not in others, but in some, I think the likelihood of similar consequences that happen in the U.S. are almost zero. One, if there's an extraordinary boom, it's hard to tell, because we know there's been an extraordinary boom in China, but there's no comparison to past cycles. That's unfortunate. That will only be cured by time. Okay, there's nothing we can do about that. China, like the U.S., shows widespread variation in markets. If you knew the U.S. markets well, and you knew the geography of my country, and you were looking at those figures, you would have noticed there was no price boom in Texas. Dallas and Houston did not have a boom. They didn't have a bust either. The same thing's going to happen in China. There'll be markets that do just fine in China, and there will be markets, I think, that are going to suffer substantially. Third really big difference is leverage is low in China, at least at the household level. It's much, much lower than in the U.S., but that poses a different risk. What that tells me is that even if there is a price collapse that's more widespread than I think is going to happen in China, it won't kill the banking sector. Why? Because there's an equity cushion among the homeowners. They'll be able to absorb it. Now, that's still going to impose real consequences for China, and it's a threat to their new growth strategy. Why? The new growth strategy, China understands it can't grow. And being such a large country now, they know they can't double exports every few years. Right? If you do the math on that, believe it or not, in 8 to 9 years, they take over all exports in the world. And probably that's not going to happen. The U.S. and Germany are going to react. Before that, so China, understanding that, has decided they need to generate internal growth. Well, are you going to be able to generate internal growth if household balance sheets are getting impaired by house value drops? Not likely. That's the real risk to China. And the other risk I'll talk about at the end is the motivation for owning is different in China, and I think there's reason to worry that there's substantial overinvestment in housing. And the reason, how many Chinese nationals are in the room? Anybody? And also a few. Think about what you, so Yangjing Geng and I have a co-author named Wu Jing who teaches at Tsinghua. And if you ask Professor Wu what he could do with his money over the last 10 years, there were really three avenues for him. Number one is he could put his money in a Chinese bank, but he'd get a negative real return of about -3% a year on that. So deposit rates are really low in China. That looked like a losing investment. Number two, he could have invested in stocks on the Shanghai and Shenzhen exchanges. Most most institutions in the U.S. will not invest on those exchanges because they don't trust them. I think the Chinese government gave a prime example why not to trust them with their regulation this summer. So that's not a great investment for a lot of households. Number three was buy a home. So I think there's a lot of home investment in China that's driven not necessarily by the need to own a home, but because there was nothing else to do with your money. And I think that, combined with a long boom, has led people in China to have a sense of safety that I think is not really there. So let me go through the data. Like I said, and then the other thing that's different about China is it's been an emerging economy. I'm not so sure it's I think it's emerged already. So I won't call them emerging, but they have very high growth trends. And those growth trends bring different risks. I'm going to show you some data on price to income ratios in different markets in China. And they range anywhere from 5 to 12 in Beijing. Those are incredibly high. And you know, if you're a US person, you go, wow, that's crazy, it must be a bubble. But it's not, right? What's urban wage growth in those markets? Double digit per annum. So what Chinese lenders and Chinese owners count on is wages rising rapidly over time so that the high price to income ratios fall as they own their houses over years. What that says is the risk is that income growth slows. If income growth in urban China slows materially, housing will become unaffordable and you will see real demand side problems in China. The other thing that's clear in China, the big risk, is price to rent ratios are extraordinarily high. In Beijing, they're 50 to 1. Okay? What that says is houses are trading at 50 times what you can rent them out for. The only way that is stable is if you believe you will have very high price growth in the future. If people's expectations change because there's some negative shock to China, as we've seen recently, that can unravel too. So a housing market in a country on a high growth trend has its own risks. And I think we have seen evidence in the past year or so of changing growth potential for China. Most of us think it's lower than it was. Okay, so let me go through the data. This is a land price index that Yangjing and Professor Wu and I put together. It's a constant quality repeat. It's a sales price index from 35 major markets in China. And you can see land prices have gone up. These, again, are log points. From the beginning of this series in 2004 to the second quarter of 2015, this is constant yuan prices, are up 381%. That's 15% a year. Right? So the land market across these aggregate 35 cities has been booming in China, although you can tell the growth rate is flattened out. Okay? That's the different regions of China. There's census regions, east, middle, and west. The west has clearly started to deteriorate. The east is still rising. Those where all the big tier 1 markets are, and they're still going gangbusters. The middle has started to deteriorate a little. So you're starting to see real regional variation in what's going on in China. Individual cities. Beijing is one of the most extraordinary series I've ever seen in my life. And I've been studying property markets for 32 years now. That the sales in Beijing, they're up 1,036%. It's 27.5% compound average growth rate since 2004. Now, interestingly enough, I don't think Beijing's an obvious bubble at all. In some other research Yonghing and Wu Jing and I have done, when we count up the supply of units over the last decade in Beijing and compare it to population growth, that market's not oversupplied. Not oversupplied at all, it's probably undersupplied. So there are a lot of fundamentals that suggest more and more people want to come into that market. They can't supply all the housing they need. Maybe prices aren't irrationally high. Now, I would bet anyone in the room prices won't go up by 1,000% over the next decade. But that doesn't mean they have to crash. Keep that distinction in mind. Next set of slides is